Welcome back. The gas regulator is planning to open up the city gas distribution network. The PNGRB is working on a structure that allows another city gas distributor to use the pipeline network set up by another player. So how soon is the regulator planning to move this new structure, and which will end the monopoly play of individual city gas distributors? Let's ask PNGRB member Satpal Garg. Mr. Garg, thanks very much for taking out the time. Obviously, this is going to create some competition. You are going to see the monopolistic situation that we are currently are with the current city gas distributors coming off if this does go through. But word on the street is this is something that's going to face a lot of challenges and hurdles, and the city gas distribution companies are going to oppose this vehemently. What's your take?
No, thank you and good morning. First of all, let me tell you, as per the regulations, like whenever we authorized city gas distribution areas, the marketing exclusivity was for 5 years, and that period of 5 years has ended in many city gas distribution networks. And earlier, like we were assuming that it will be a kind of automatic, that once the period of marketing exclusivity is over, then we can start creating competition. But then the matter went into dispute, and the Supreme Court has decided that it is not automatic. The regulator has to come out with new regulations which will be containing guiding principles how a particular area can be declared as a common carrier. So now based on that, we have almost finalized the new regulations. We are supposed to carry out public consultation. That public consultation process has also been completed, and I think we are just a few months away from finalizing the new regulations.
All right. Are there
which will open up many areas which...
Right, go ahead, sir.
Yeah, please go ahead. Okay, no, it will open up like many areas which have already completed the marketing exclusivity period and bring in new players. But let me also put a word of caution here. As per the regulations, what we are thinking is that 80% of the network can still be used by the authorized entity, and it is only the remaining 20% which has to be offered for public use or for the use by other players. So to that extent, the interest of authorized entity is being taken care of, and it will also create competition in the market.
Okay, indeed it will. But sir, I believe, are there any bigger legal hurdles to clear, once this regulation is put in place? Because that's what most of the, the brokerages have been talking about, that while this is done in good interest, the legal challenges may prolong it.
We have tried to take care of all the legal hurdles. In fact, as I told you in the beginning, this entire issue was held up because of legal hurdle only. And now, based on the whatever Supreme Court and High Court decisions are there, based on that only we have framed new regulations. And my understanding is there is one case which is still pending in High Court, but there is no stay on the implementation of this common carrier regulations. And we already have carried out public consultation process. We have now before us the views of various CGD entities, consumers and other stakeholders.
Right, Mr. Garg.
So as per my understanding, we don't feel that there is any hurdle in this.
Okay, no hurdles. Mr. Garg, just a follow-up. How many of the current circles have ended that 5-year period that you spoke about, which would be what percentage essentially of the existing network is up for getting this 20% use by the company which didn't set up the network in the first place?
No, in fact, at present there are 230 geographical areas which have been authorized, but out of these 230 geographical areas, about 138 have been authorized only during 9th and 10th CGD bidding round. So till 2017 we were only having 92 geographical areas. I think more than 50% of these will be qualifying for to be declared as common carrier.
And unless I'm very wrong, Dharmendra Pradhan, the minister in one of the conclaves mentioned that entities which had won the CGD rights in the earlier rounds of conduct bidding rounds have not quite moved very actively to set up the networks as well. I think there was a call given for them to, not delay the work, and PNGRB was asked to strictly monitor the process. Has the layout of the previous bidding rounds now started actively?
One thing I think which we have, once this current board took up the charge in 2017, so one thing which we gave a lot of focus was monitoring of the progress of all CGD entities, and I think barring a few, now almost all entities are now progressing well. Say, I don't say that everyone has met the targets, but earlier there were many companies which have just not started, so there was no work done. So if in that category there is hardly any company now who have not done any work, and now most of the companies are progressing well, and so far even 9th and 10th bidding round is concerned, which were authorized only during 2019. But even in those cases, we are monitoring the progress on a continuous basis, and that way we are quite happy or satisfied about the progress being made by GAs which were authorized during 9th and 10th bidding round, and even earlier GAs.
Okay, so can you also give us a sense as to how this will benefit consumers with regards to tariffs post the implementation of this 20% being utilized by other gas distributors? How would that impact tariffs, and will that be beneficial for consumers?
I think it will help the consumer in terms of gas price. So far tariff is concerned, there are certain areas which were awarded under bidding rounds, and the tariff in those cases is just 1 paisa, that is just a nominal amount. But in areas which were operating even pre-PNGRB, in those cases we have to determine the tariff based on certain assured rate of return. So tariff is not an area of concern. I think the opening up of geographical areas will create competition in gas price, and I think now many people say that the CGD companies are charging some super profits on the gas price because of exclusivity, marketing exclusivity. So I think in terms of gas price, the competition will be there, and I think it should be helpful in reducing the prices to some extent.
Mr. Garg, one important aspect also is the fact that the government is looking to increase the contribution of gas in the energy basket. How do you think this can be achieved?
No, we in PNGRB as well as Government of India or Ministry of Petroleum and Natural Gas, we are working to increase share of natural gas from current 6.2% to 15% by 2030. And in this direction, basically we are focusing in just 2-3 areas. One is creating more and more infrastructure in the pipeline infrastructure in the country, that is trunk pipelines. And in that direction, like recently government has approved this VGF, viability gap funding for Indradhanush gas grid in northeast of India. And earlier Jagdishpur Haldia was given 40% VGF. So and by now I think after authorizing this Srikakulam-Angul pipeline, I think the basic gas grid of the country will be complete once these authorized pipelines are laid down. So that is one area where our focus is, and second area is the city gas distribution. As I mentioned that in 2017 we were only having about 92 geographical areas, and now we have 230 geographical areas covering more than 400 districts of India.
Okay.
And we are also planning 11th bidding round. So 11th bidding round we are thinking of covering another 50 to 60 districts of India.
Okay. Mr. Garg, one last question from my side.
Like city gas distribution will be.
Okay. So I just wanted to know from you, there are reports that are suggesting that discussions have begun to set up a gas trading hub, and also the fact that there could be the inclusion of natural gas under the GST regime, which would mean free natural gas movement across the country. Do you feel that that's something that can happen?
Gas trading hub is another focus area for PNGRB, and we are working on gas trading hub for almost now more than 18 months. And we have slipped on target for creating gas trading hub. There are certain decisions which we are awaiting from government, and GST is one such focus area, one such area which is not absolute necessity for creating of gas trading hub, but it will facilitate functioning of gas trading hub and creating liquidity to a great extent. Because without GST, there will be the VAT rates or the value added tax rates, they are varying from 3% to 20% across various states. So GST will be a big facilitator, and there are certain other decisions I think which the government has to take. So one is the separation of marketing and transportation functions, wherein the creation of a subsidiary of GAIL for market transportation function is being talked about, and we also need a separate transmission system operator, so that the people get open access to pipelines, and like there is no undue advantage to the pipeline companies in comparison to other gas traders. So these are certain areas, like once we have these decisions in place, I think we will be coming out with gas trading hub. We will be able to make operational in next, I think, 3 to 6 months, once we have the requisite decisions from the government.
Okay, Mr. Garg, we'll leave it at that. Thanks much for taking the time out and being with us. Really appreciate your time.
Thank you.
That's the view from PNGRB member, Mr. Satpal Garg. Let's move on to some earnings and good set of numbers. Greenlam reported a healthy set of numbers in the third quarter. Plywood makers saw its net profit rise 45% in October to the December quarter. Margins also improved. But the question is, can demand sustain and improve? Joining us now with the answers is the company's MD and CEO, Saurabh Mittal. Saurabh, good having you. Thanks much for joining in. Good numbers. Hi, congratulations. First, a bit on the demand environment, then we'll get to the margins. How have the volumes looked like, and what do you anticipate the near term to throw up?
So firstly, let me tell you, we're not a plywood maker. Laminates is a core business, so we are more laminates than ply. So on the volume front, in the last quarter, we've had about, in the core business, which is laminates, we've had about 7 to 8% of volume growth, which is primarily coming from the export markets. The domestic market has been flattish. In the veneer and allied category, we've had volume growth in the flooring business and the door business. The decorative veneer panel business has been, actually we've had a small degrowth in that business. So that's on the quarter three performance. As far as demand conditions are concerned, so demand conditions continue to be challenging. And so really, what's going to happen to demand, I'm not sure on that. But as far as we are concerned as a company, I think our efforts of continuous network expansion, working with specifiers in the domestic market, globally expanding our market reach, working with customers, developing new products. So I think that continues. So really, I think we are more focused on, what we are doing rather than really what the overall, noise and the market environment, we see.
Okay. How does this kind of demand expectation and, for lack of a better word, uncertainty around what the demand will likely be, augur for the operational metrics? Because you've shown some positives out there. Can these sustain or improve?
So I'm not sure whether they can sustain or not, Our efforts, like I said, across the business, is completely there. We are very focused on, building a good business. And so it really depends, So if you see the results of quarter three, despite the fact that, demand was not so great. The domestic business, was kind of subdued. We still managed to improve our pricing realization. We improved our value mix, and which is more of a continuous effort, over the last few years. It's not something which has happened in a quarter. So really, I think our efforts will be there, and probably, we should try and sustain this level of performance. Whether it can improve or not, and I'm not sure on that right now.
But this 50% margins, you believe they could be sustained within a band of maybe 100 basis points, but this could be sustainable. Am I getting it correct? You can't be. Okay.
That's our effort. So if you look at the margin in the core business in laminates, so we've done about 18.5% EBITDA margins. Our new businesses continue to lose money, and that's dragging down the performance, of the margins. So the veneer business is largely flattish. We literally made no money at the operating level in the decorative veneer and allied category. Although the veneer panel business had a 13.5%, operating margin, but the flooring and door business still lost money. So overall, yes, I think these numbers you're seeing, is where the two new businesses are still, losing money at the EBITDA level. So we should be able to sustain these margins.
The laminate exports have been gaining traction. How did they do in the third quarter? How do you anticipate them to do going ahead?
So the laminates business in the third quarter did reasonably well. We did about 25% rupee term value growth. In quantity, we grew about 20%. So I think it will continue to do well in the future too. We are the largest exporters from the country. We have a good network internationally. We have a good product lineup. Supply chain is very efficient. So I think we should be able to do well in the future too.
Okay. Just wondering, one is what happens to the EBITDA margins, and that will be a factor of a number of things. But the 190 basis points gross margin expansion that you showed, because of the categorization, I think the premium category products went up and raw material costs came down. Now I can understand raw material costs might be unpredictable, but the composition of your sales would be in your hands. Would you reckon that there will be a further push towards premium products?
So like I said earlier, this is something which is a strategy of the company to keep driving the volume and the value mix. So introduction of new products, pricing discipline is very important, and I think we've behaved very well on that front. So I think the gross margin improvement is a function of better product mix. If you see, our realization growth has been nearly 5%. In a market which I believe most people have been discounting products, which is a function of pricing discipline and better value mix and continued efforts towards focusing on getting better products to the customers, and really not just focus on cost leadership, but also product leadership, market leadership. So I think that will continue. What impact it'll have in 1 quarter, 2 quarters, I cannot say that, but the direction is there, yes.
Well, Saurabh, we wish you all the best, and good show in the third quarter. Hopefully it sustains in quarter 4 as well. Thanks much for speaking to us. Well, that's Greenlam with the numbers. Can't predict the sustainability, but hopeful of that. The stock, though, doing very well today because the third quarter numbers were very, very strong, both on the EBITDA front as well as the bottom line front.
All right, KPIT Technologies revenue remained flat in the third quarter. Margins, though, improved, and so did the net profit numbers. But it's the revenue decline from America and the rest of the world that could throw investors off guard. Joining us now to talk about this and more is Vineet Desai. He's the Chief Financial Officer at KPIT Technologies. Vineet, thanks very much for taking out the time. Let's talk about that. What happened in America and why are the global revenues looking this weak?
Okay, first of all, good morning and wish all of you a very happy new year.
Same to you.
If you look at from a business perspective, I don't think so. We are looking. I'm worried so much just looking at 1 quarter, because if you look at our first half, our performance, all the geographies have shown growth. If you look on year-on-year basis, also all the geographies are showing growth. So it's not that we look at it from a 1 quarter perspective. It's always a global aspect. From a regional uptick perspective, we have always been mentioning that Europe and Asia will be the highest growth drivers, and that continues. Looking at the current pipeline, it looks to be the same.
Mm-hmm. Okay, so just give us a slightly more forward-looking statement in terms of how Is the pickup likely to be in these geographies, come the next few quarters? I believe you've, in terms of deals, garnered deals across Europe. You've got a German tier 1 supplier. You've got a lot of orders coming in from America as well, a leading American tier 1 supplier for an electric powertrain project. What is the value of these deals per se? And are these orders where you're expecting a more consistent flow year on year, or these are one-time orders?
No, see, if you look at our strategy, it is to focus on these top 25 clients across the geographies. And when we look at right now, the major orders are coming in the two areas. One is the powertrain, both conventional as well as the electric side. And the second one is the advanced driver assistance features and the autonomous driving. These are the two major places from where we see the growth coming in. If you split it by geography perspective, we see more uptick on the autonomous driving and the advanced driver assistance features more in the Europe side. But when it looks to electrification, I think so it's pretty much across both the geographies. Now, the way our business model works is we work on programs for the vehicles and the models that are likely to be launched in the next 2 to 3 years time frame. So when we look at from an order perspective, we are not looking at from a SOW or a purchase order that comes in quarter on quarter basis. We look at, are we part of the program? Are we part of the leadership pack in terms of our delivery schedule? And once you do your delivery and once you are able to successfully cross the milestone, you are automatically qualified for the next level of program. So technically we look at, yes, are we there in the 3-year game that these all customers are looking at? And we think we are very much well positioned to garner the maximum amount of wallet share from them.
What about the fact that there are still consistent pressures? I mean, you've seen how car sales have been across various geographies, US particularly, further slowdown that is anticipated to come in. Europe, on the other hand, with regards to the overall job market and further job cuts anticipated, spending, purchasing, cars with the kind of technology that you provide could be an expensive proposition. So, maybe looking at demand petering off from these areas?
Not really. Again, just repeating my last answer. As I said, we are working on programs for the next 2 to 3 years. So our revenue model is not necessarily linked to the vehicle sales that happen on day-to-day basis. But if you look what gives me the confidence in terms of our revenue and the growth profile for the next couple of years is that all of these leading players are continuing to invest into the research and development part in terms of electrification and the autonomous driving and the connected vehicle. And we are not seeing any cuts in those programs as of now. And we feel that every player is basically looking at launching all the new models. None of the players have sort of taken back any of their programs, and they are all looking at launching their models in the next 2 years, 3 years time frame as the uptick happens. So we are not really worried about the vehicle sales that happen on day-to-day basis, because that doesn't impact us on our revenue model. Okay,
so let's talk about the focus on where exactly are you expecting your revenues to pick up maximum from, whether in terms of your AS, powertrain, connected vehicles, where are we looking at the most amount of traction?
I think so across all the three, but electric powertrain, if you look at powertrain as a practice, both conventional and electric we are seeing right now there is a good amount of spending happening. Conventional, we still believe there is a long life to go. It's not that it's going to be completely outdated. People are continuing to spend. Yes, but in terms of the new projects, if you look at it, there is a more spend and more focus on the electrification side of it. In terms of advanced autonomous driving and the advanced driver assistance features, I think so the autonomous driving programs, compared to the autonomous driving, I think so the advanced driver assistance features programs will take a much more front seat in the coming years, and we will see more growth coming up on that side. Last not the least, the connected portion of the vehicle, as the infrastructure becomes much more connected with the vehicle and more software goes into a particular vehicle, you will see a significant growth coming on the connected side of it. The side, the byproduct of that will be the diagnostics part of it. We are seeing a good amount of consulting opportunities in our pipeline, and we see that's also another area in the coming years that will show a significant growth. And that's a good business to be, because diagnostics is going to be a good profit margin business for us.
Okay, just one last question. From a slightly longer term horizon, what is the big game plan at KPIT Tech in terms of numbers and growth performances? I mean, you're clocking in margins of 8.2%, your EBIT is growing about 14.5%. Where do you intend to be? Revenues are a bit sluggish this quarter, but what kind of growth rates are you projecting or targeting at KPIT Tech?
See, I would not look at that in terms of, we gave an outlook of 16 to 18% for the current financial year. I think so we are pretty much close to achieving that. In terms of our profitability, we want to make a significant improvement from where we are, and there's a continuous focus on that. In terms of, if you look at our EPS guidance, we have already crossed our EPS guidance that was given at the beginning of the year on an annualized basis. Most importantly, all of these performance is also translating into a significant improvement in our cash balance. If you look at our DSO, it has come down to be one of the lowest in the industry. We are completely debt-free in terms of our short-term debt. We have only one long-term debt on our books that also will get completed in the next 15 months. So we are looking at becoming much more stronger, having a stronger balance sheet, a stronger cash position. Our interim dividend announcement is also just an acknowledgement of that fact that our cash conversion machinery is working very well. And I also want to remind you also that this January we have completed 1 year as from where we started operating independently as a completely focused entity on the embedded electronic software for the mobility sector. So overall, if you look at it, we are confident that we will continue to deliver industry-leading growth. We want to improve on our profitability parameters. Historically, if you look at where we were 2 years back and where we are today, there is a significant improvement, and we want on profitability parameters also to be equally competitive with the industry. So that's a general outlook, I would say. In the by next quarter, we will be in a position to give you an outlook about what will happen in financial year 21 and beyond.
Okay, Virendra, we'll leave it at that. Thanks much for taking the time out and being with us today and giving us your thoughts. Appreciate your time. Well, that's the view from KPIT, but the market's lying absolutely, actually flat, down about 0.5% for the Nifty Bank. The large caps about 0.4%. It's a wrap on this leg of Indian Open. From Devini and me and the team that put this show together. Thanks so much for watching.